Good morning, everyone, and welcome to today's presentation on reading candlestick formations. Now, before we get started, I do want everyone to take just a moment to read over the disclaimer. And basically, anytime you are trading, there will be risk involved, even with binary options. So never trade with money that you cannot afford to lose. Now, my name is Gail Mercer, and I'm going to be your hostess for this morning in the webinar. It is an educational webinar. Hopefully, you're going to learn something from it. Now, I have about 15 years of trading experience. I actually started out with a company that programmed indicators, and I just fell in love with the price bar, to be quite frank. I specialize in price action, volume analysis, and divergence simply because I believe they are leading indicators. I'm also a frequent contributor to Stocks and Commodities magazine, Traders World, and Top Shelf. I've also been a speaker at Traders Expo, Traders World Online Expo, and the Wyckoff Volume Conference. I'm also the author of Trading Nadex Binary Options, Keeping It Simple Strategies, and the New Trader's Guide to Trading Nadex Binary Options and Spreads. And both of those books can be purchased either on my website or on Amazon. Now today we're actually going to learn the different candlestick formations. For example, the bullish versus the bearish, and multiple bar formations. Now, all of the candlestick patterns that you see on the charts today are provided by NinjaTrader 8. And we're going to start with a bullish candlestick. Now, for those of you that are not familiar with the candlesticks, the body is the colored portion. Sometimes they're transparent or clear. And then you have a line at the top and a line at the bottom. The bullish candlestick, the open is down here at the bottom of the body. The close is at the top of the body. The high is the top of the wick, which is this line right here. And the low is the bottom of the wick. So you've got the wick in the body, and according to the color, you can immediately identify where it opened and where it closed. Now, a bearish candlestick opens at the top of the body, closes at the bottom of the body. The low is the bottom of the wick, the high is the top of the wick. Now, these are your bullish candlestick formations. Now, what do I mean by a bullish candlestick formation? It simply means that the next bar should go in that direction. A bullish formation indicates that the next price bar should go up. So in this case over here, you first have a bearish candlestick followed by a bullish candlestick that actually exceeds both the high and the low of the bearish candlestick. The next price bar should go up. Then on this formation, we have a bearish. Then we have another bearish that almost forms a doji. It closes in the middle of the bar, and it is followed by a bullish formation. Again, this bullish candlestick indicates that the next bar should go up. We then have a bearish, followed by a bullish, followed by one that sort of looks like a doji. The close is equal to the open. But notice how it went down and it made a low. And this one is very significant because buyers were actually able to step into the market and push the price right back up to where it opened. This is what makes this candlestick formation indicative that the next candle will actually go up. We then have a bearish candle followed by a bullish candle. What is special about the bullish is that it is very similar to this one over here, in that they went down, they made a low, but then buyers were able to step in and push it right back up. Now, these two are really good formations. They're like the perfect formation, but we don't always get the perfect formation on the live edge of the market. That's why I put this one on here, because even though it is a bearish candlestick, notice that the information is really the same. In other words, when this opened, they were able to push it down and make a new low. And when they did, buyers stepped in and they pushed it right back up. And that's the price action behind the bar is what is important. Does everybody understand that? All three of these formations, this one, and this one, are actually indicating exactly the same thing, in that they first open, this is your open right here, they push it down, but then buyers come in and they push it right back up. That's the formation that we're looking for. In this one, they open, they push it down, make a new low, buyers step in, and then they push it right back up. This formation, they open, they make a low, then buyers step in and they push it right back up. Those are the formations that I'm actually looking for. Okay? Now, let's go to the bearish formations. The bearish formations are kind of the opposite of bullish. First, this one is the bullish bar followed by the bearish bar. Notice that the bearish bar exceeds the high and the low of the green bar. Do you see that? Nicole, is the open always on the bottom? If it's red, the open is at the top. If it is green, the open is at the bottom and they push it up. Does that answer your question, Nicole? So for example, here, this is a green candlestick. So your open is right here. Let me change that pen color. So your open is down here. Your close is up here. If it is red, then your open is up here. Your close is down here. Okay? Now, it is very important that when you see this formation, that it actually exceeds the high and the low of the previous bar. Okay? Now this one, we have pretty much the same thing, in that this is a bullish bar followed by a bearish bar that exceeds both the high and the low. And in this case, they take it up, they make a high, sellers step in, and they take it down and it closes on the bottom. Okay? This is indicative that the next bar will go down. Then we have a bullish followed by a bullish candle, followed by a bearish candle. Now notice on this one that they went up and they made a high that is higher than this bar, but when they did, sellers stepped in and they took price action down. Okay? In other words, they were not able to close at the top of the bar. Then that is followed by the bearish candle, which tells you more than likely the next bar is going to be down. And this typically is an inside bar right here. And what it's also telling you is they don't have enough power to continue to make a new high. We then have a 2-bar formation that looks very similar, and that this makes a high, but then it closes down here at the bottom. And it's really kind of telling you the same thing in that the buyers came in, they took price up, but then sellers stepped in and they pushed it right back down. This is indicative that the next price bar will go down. We then have a bullish bar that is followed by a bearish bar. Again, same concept in that they opened the bar, they went up, and then sellers stepped in and they took it down. Preferably, you want it to close down here. But again, we don't always have the perfect formations. I would consider one that closed at the very bottom stronger than one that closed in the middle of the bar. Okay? Any questions on these bar formations? So does the price of the following candlestick always start where the previous one left off? No, it does not. And that's what you would consider a gap, Eduardo? Now, let's go to the next price bar formations. And this is called what I call the bullish twin bar formation. And what is significant in this one is you have a red bar, and usually these are big bars. You don't want to use these on these teeny bars at all. These are typically big bars. It goes straight down, and the next bar goes straight up, okay? You can see they look identical, except one goes down, one goes up, okay? This one indicates that the next price bar should be up. Then we have the bearish twin bar formation to the downside. In this case, we have a bullish bar followed by a bearish bar. The next price bar should go down, okay? And all it is telling you, okay, they pushed price up, sellers came in and said, no, you're not, and they're taking it straight back down, okay? We also have what is called the doji. Now, a bearish doji indicates that the next bar will go down, okay? So if you notice, all of these are making new highs, a new high, new high, new high, new high, new high. Then you get this one, and notice that it closes right down on the bottom. The next price bar should go down. And this is a bullish doji in that all of these are making lows. Then you get this one, it makes the lowest low. The next price bar should go up, okay? Now, if you need to contact me, you can visit my website at tradershelpdesk.com, or you can email me at gm@tradershelpdesk.com. And we're going to go look at a chart. It's going to be on the USD JPY, and we're going to see some of the bars on what I call the live edge of the market. Now, I'm not focused on doing trades. I'm just focused on reading price bars, okay? Now, using the price formations that I just showed you, you can see this is exactly what I'm talking about, okay? And this was actually indicative of what's going on right now in the market, okay? That bar said, in this one right here, which is a bearish bar. Notice they went up, they made a high, then they took it right back down. That was indicative that this is going to be a down bar, okay? Now, this is what I'm talking about with the twin bars. We have a bearish bar followed by a bullish bar. In other words, when they opened this, sellers came down and they pushed it down. And then buyers said, no, I don't think so. And they took it right back up. Do y'all understand that? Now, if you saw the presentation that I did on support and resistance, I believe it was last week or the week before, this was your high, okay? They came back to test that high right here, and they rejected it. This is a reversal bar right at the high. This is indicative that the next price bar would go down. Do y'all see that? Price goes down. This is the price bar that said, hey, the next bar is going to be an up bar. Do y'all see that? So we get an up bar here. This one closes in the middle of the bar, and it's really not, in my opinion, bullish or bearish, even though it's green, because it closed in the middle of the bar, okay? We then get this down bar here that does exactly the same thing. It closes in the middle, okay? Then we get the bullish bar. It closes above this, the high of this bar. It tells us that it should be followed by another bullish bar. It is. The next bar forms a high. It is actually a rejection of this high. They have now tested this high twice, okay? Forms a reversal bar. This is actually the outside bar. Do y'all see that? It exceeds both the high and the low of the previous bar, and down the market comes. How can you use these bars to enter trades? Okay. It depends on whether you like to trade in the money, at the money, or out of the money. Okay. I prefer out of the money. Okay. So I wait for a bar like this, and then I go out of the money. And usually I would target this area, but a lot of it depends on the risk associated with it, okay? If you were trading at the money, you would probably take this trade on this strike at 111.40. If you're trading in the money, then you would probably take the 111.60. Do you understand that? Now, you can also use these price bars to exit a trade. For example, let's say that over here we decided on this bar, okay, the market's going to go down because we just had a bearish candlestick, okay? And we're going to use this strike price right here. But then we get the next price bar. Should that price bar should it have formed that way? Should we have a bearish bar followed by a bullish bar? No. So you could actually say, okay, I don't like that price bar formed, so I'm going to scratch the trade. Do y'all understand that? Just another way that you can incorporate price bars into your trading method. You could also say, okay, each time it makes a reversal bar, I'm going to look for an entry, because we know we're in a downtrend, we're making lower highs. So you had a potential entry here, 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 here. If I can get my arrow right. You could have had one there. And this is all into the downtrend. You didn't get what, Nicole? Over here? Using it to exit, Nicole? Okay, if this tells you the next price bar should go down and the next price bar goes up, why would you stay with that trade? Is price doing what you anticipated it to do? If the answer to your question is no, then you say, okay, I'm going to scratch this trade and I'll wait for another setup. Do you understand that now, Nicole? Now, another way that you can incorporate price bars is by pulling up another chart. This is a 5-minute chart. I mean a 60-minute chart. So let's just pull up another chart. And again, I'm not focused on trading today. I'm focused on teaching you how to use price bars. Let's go down to a 15-minute. Okay. Did you see how you had this double top formation? Then you had the reversal bar here. Again, you could actually trade a 2-hour binary instead of a daily binary. Do y'all understand that? Because what you're trading is actually the reversal bar that formed on your 60-minute chart. So you're really trading that, okay? But you're verifying it with the 15-minute and then go down to a 2-hour. I typically trade the 2-hour binary. Usually I'm doing it with 1 hour remaining. Do I like the 5-minute binaries personally? No, I don't. What is a binary? It's a time-based limited trade opportunity, okay? And basically you either say, hey, this, for example, right now, we have a strike here at 111.40. If you believe by 3 o'clock this afternoon that the USD JPY will be above 111.40, then you would buy it, which is the blue number here. If you believe that, no, it will not be above 111.40, then you would click on the red number and sell it. How did the upper tail form? Okay, this is a red bar, so this is your open right here. Okay, this is the body. The open is at the top of the body. Okay, so when this opened, it went up, it formed a high, and then it came down and it closed right here. That's what formed the tail. They pushed price up and then they came back and they closed it on the very low. A reversal bar, for example, you have bullish, 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 bearish. This is your reversal bar. Here you have bullish, a doji, a bullish, and then this is the confirmation of these reversal bars. Yes, at one point it would have been bullish. And the only thing that forms it is if the price bar opens and it goes up, okay, and it closes up here, okay, this is the high, this is your wick, this is the low wick, okay. So your low is here, your high is here, and this is green, okay. This is your open, and this is your close up here at the top of the body, okay. If it is a bearish candlestick, then you have the open, and it typically will go down, and this is your close. And this is a bearish. But you typically will still have your wick, okay? So this is the low, this is the high, and this is the body. The only difference is on the red candlestick, which this is red, your close is going to be down here. Well, I think which binary you trade is dependent on your personality. I like 20-minute binaries, but sometimes it depends on how the market is moving, Chris. But I do like 20 minutes. When you are in the 60-minute binary, do you keep your resolution at 1 hour, or do you bring it down to a lesser minute amount to more accurately follow the candlesticks? That's a lot of people think, okay, if I go down in time, I can see it quicker, but you have more noise when you do that. Okay. What is noise? Does anybody know? The open of the candlestick, literally. Where does price open at 11 o'clock in the morning? Okay. The bar starts at 11 o'clock. Where is the open? And the close of one bar could be, for example, 111.45, and on the next bar, it would be 111.50. Okay, that's a gap. Hold on just a moment and let me open Ninja Trader, and I can show you what gaps look like. If you want to see what gaps look like, you can easily do this. I've just got to open Ninja Trader to show you. Okay. Now this is the ES, and actually you can even see it today. All right. If you're looking at this bar closed here at 24.39.25, but it opened at 24.39 on this bar, which started at 10:30. So at 10:30, the opening price was 24.39, but the close of the previous bar was 24.39.25. Now, if you really want to see extreme cases of it, just look at the ES. Usually overnight, you'll see a lot of gaps in price. See, here's one here. This one closed at 24.31, but it opened at 24.31.50. Okay. Yes, they do send out the recordings. What is the difference between the body of the bar and their wicks? The wicks identify the highs and the lows. The body actually identifies the open and the close. Open on a green candlestick is at the bottom, close is at the top. On a red candlestick, open is at the top, close is at the bottom of the body. Does that answer your question, Giovanni? Now, see, right now on the USD-JPY, we just got a bullish bar indicating that this bar should go up. Okay? Yeah, they work the same. For example, I trade Duke Energy a lot, and we can put this on a daily chart. There you are. This indicated that the next bar would be a down bar. So far, it's proven true. You know, candlesticks, it works on a weekly. I mean, pull up a weekly chart. There's your weekly. The green means exactly the same. The red means exactly the same. Go to a monthly. The same thing, means exactly the same. And in July, I'm actually going to show you how to read the multiple time frames together. Yes, you can, Frank. You can have NinjaTrader. I've got 6 monitors. So I've got NinjaTrader on one, Nadex on another, and market reports on another. Okay. Is it a good rule of thumb to look at 2 or 3 bars? It depends on the formation. You know, if I'm looking at this bar, I really don't need to wait until that bar. The fact that this made a high is higher than the previous bar, that's all I need to know. Okay. I use it on both my higher time frame and my lower time frames. Did you see how this right now is showing that this is going to be a reversal bar? In other words, you're getting a reversal bar on your 15-minute chart, okay? If this continues, which is going to make this a reversal bar over on the 60-minute. Which pair do I usually trade, or which pair of reversal bars do I trade? No, if I'm trading a weekly, I'm using a daily. If I'm trading a daily, I'm using a 60-minute. If I'm doing a 2-hour, I'm probably using a 15-minute. Yeah, it just depends on what you're trading, what time period you're trading. How to read edge, maybe, or predict with respect to bearish or bullish candlestick. Well, this one actually said that the next bar would be bearish, and it was. This one says the next bar will be bullish, and it is. Does that answer your question? Okay, the wedge is beyond the scope of this presentation. You're talking about price formations like triangles, wedges, double tops, double bottoms, all kinds of things, pennants. Okay. If I want to trade a daily, what will I use at this point to predict the trend line? I think it depends on your trading plan, but if you're trading a daily right now, the first thing that you would say, okay, is this chart making higher lows or higher highs? Okay. longer term, it's not making higher highs. So I would probably go first to a daily and say, okay, what is my daily showing me? The daily is showing me that we're in an uptrend at the moment. We're making higher highs. They just came up to this high. It would be important for me for them to break that high. That's when I go down to a 60-minute chart and say, okay, I'm going to wait and I'm going to actually see what this price bar does. If it continues to be a reversal bar, then, you could potentially have an entry point. But then you have to consider, do you want to use out of the money? Do you want to use in the money? Or do you want to use at the money? Because there's 3 different ways that you could potentially trade this. A 2-hour, I use a 15-minute. 20-minute, I use a 3 and a 12 because that's what I trade. Okay, can I go over all 3 entries? Sure. And let's use this one because it's already spaced out. Now, the first scenario I'm going to go through is for longs, okay? And for longs, currently, tell you what, let's go down. It's going to be easier for me to go down to a 2-hour. Okay. Let's refresh this. And let's go down here. Okay, so this is a 2-hour binary option, okay? And we have strikes every 4 pips on this. So if I wanted to go long, my at the money would be right here, okay? The risk on that trade is 54.25, okay? That's kind of your midpoint on risk, okay? Now, if I wanted to be in the money, that means I need to go down at least 1 full strike. So this is the current at the money strike. I'm going down 1 full strike, and it would be 66.50 in risk. Okay, so this is the in the money, and it will have the highest risk associated with it. Okay. And then your out of the money would be 1 full strike above it. Okay, so this is 1 full strike above. And notice that the risk on that one is 40.75. Does everybody understand that? Now, literally, if you think about it, because when I had to learn this, it was kind of hard. And literally what you want to see is that if you're buying this strike, which is at 111.46, okay, you're already literally in the money, okay? Meaning that price is trading at least 1 strike above your strike, okay? Does everybody understand that? Okay. Do I set the price? If you click, for example, if I click buy, it's automatically going to fill that in for me. Do you see how it says buy? And I've got it where it's a limit order. It's at 50.25. Now, if I want it at the current price, I just click on the offer. Okay. And it always, and I mean, really, learn to read your tickets, okay? Your max loss is 51.75. Max profit is 48.25. Does everybody understand that? Okay. So let's get rid of all of these. And I'm going to cancel that. And let's go say, okay, I think it's going to go down. Okay. What's your at the money, in the money, out of the money? Okay. It's reversed. Your in the money would be one strike above where price is trading. So you would click on the red box here. Your at the money is where it's currently trading. This is your at the money, which is 111.50. And the out of the money, which literally means that price is not there yet, is down here at 111.46. And you would always do the red boxes because you want to sell. Does everybody understand that? And I'm just showing you examples. I really don't have an opinion of this to whether the market's going to go up or down. That's not my job today. My job is to educate you today. If you believe, okay, this is, let's say that you're interested in this strike, okay? Literally, this is the statement. Do you believe, and just type yes or no, okay? Do you believe the USD JPY will be greater than 111.46 by 1 p.m.? And this is what makes it a binary, guys, okay? Do you believe that that statement is true or false? Yes or no? Okay, if you believe yes, indeed, the USD JPY will be greater than 111.46, then you buy, okay? If you think no, the USD JPY will not be greater than 111.46 by 1 p.m. today, then you sell, okay? Does everybody understand that? That's what makes it a binary. It's only two choices. It's either yes or no, buy or sell. But it has to do it by 1 p.m. because that's your expiration time. So where the in the money, at the money, out of the money positions are depends on whether you want to purchase a call or a put option. Exactly, Tiffany. You nailed it. Because not only is it a matter of is it going down, but will it get there? If you're out of the money, will it get there before your expiration? Okay? Why did the in the money and out of the money reverse from before? It depends on what direction you're going, Mike. If you're buying, it's going to be the opposite of when you're selling, okay? In the last webinar I attended, the host mentioned something about an advanced technical analysis course for free. Trader Joseph, if you go to the archive webinars, you can go back to that webinar and watch it again and actually get that information. Okay, I have 3 monitors. The first is 1 minute chart, the second is 2 minute chart, and the third is 5 minute charts. Do I have the right ones to trade 1 to 2 hours? I wouldn't be looking at a 1, 2, and a 5 for a 2-hour binary. I would take it up to a 15 minute. You have to go into the webinar that was recorded. In that case, I don't know. Maybe he gave his email address in the presentation. That's what I do. Jimmy, normally the at the money will be the same regardless of whether you're buying or selling. I have seen exceptions to that. And usually like it's normally when, because I do it by risk, okay? And normally, let's just say that it's trading right here in the middle, then this may be your $50 risk area for a long, but your $50 risk area for a short may be down here. So I have seen it where, you know, for the short and for the long, it's not really the same. And that's why I like to give you, you know, a risk level. Typically at the money, it's between $50 and $55, okay? And that's the reason I like to give you that numerical representation, so you'll know when those cases actually pop up, you'll know, well, I'm probably better off taking this one. Does that make sense to you, Jimmy? Now, and what is this? This is a 1 hour chart. Now, do you see how this turned into the reversal bar? So this is indicative of what? What should the next price bar be? It should be a bullish bar. It should go up. Does everybody understand that? And this is where you could come down to, for example, you could come down to a 15-minute chart. Well, that's the wrong one. Let's go back over here. And put this one on a 15-minute. Okay. And this has about 12 minutes before it ends. Okay. Is the 15-minute confirming what we're seeing on the 60-minute right now? Why not? This one is actually going down. Do you think it will change this bar within the next 10 minutes? And really, this is your question. Will it change the formation on the 1 p.m. expiration 60-minute chart? All right, now you have a choice, okay? And this is for demonstration only, okay? If you wanted to do an in the money, we want to go long, okay? If you wanted to do an in the money, it would be the right at $67, $66.50, okay? This would be your in the money, okay? This would be your at the money. It's got 52.25 in risk. And this would be your out of the money, okay? Now, I'm going to write them on there so y'all can see it and you actually understand. This had the most risk. This was in the money. This was at the money. and this one is out of the money. Okay? Now, you have until 1 p.m. expiration. Now, in order for this one to make money, price has to get above 58. Okay? Now, this one will make money as long as it stays greater than 111.54. That's your strike price. Okay? This one is about one tick away from being in the money. So you got 111.58. And on this one, it has to move up to 111.62. Okay, so this one, it has to move to this. This one is already trading there. This one is already trading above that. Do y'all understand that? What indicator do you recommend to use? What are your favorites? I actually designed my own indicators for TradeStation, NinjaTrader, and MultiCharts. And they're based on the stochastics, the ADX, and a trend algorithm that I designed. So those are the ones that I use. And, you know, I think as long as you believe in it, I think anything will work. As long as you do the same thing day in and day out. See, this is what I use. So this is already telling me it's probably going to go up at least to this area. And that's confirmed with the stochastics being overextended. I'm a firm believer in there's no magical indicators. The only magic comes from the way that you trade it. Now, in this case, and you still have more options, okay? For example, on this one, we could actually put in a profit target at 95, okay? Because we're going up in premium. We set it higher than where we entered. On this one, we could set, let's say 90 for a profit target. And then on this one, we could actually set an $85 target. Okay. Now, do you see how I have these gray boxes here? That tells me that we have profit targets in the market. They're available on my website for purchase, Saul. Does everybody understand that? Now, what's the key to allowing this to expire? The key is 1 p.m., and that's about an hour and 6 minutes away, okay? Now, the way the binaries work is if price expires greater than, okay? It's not equal to, it is greater than. Notice over here, you have 111.611. See that extra digit there? That's what determines whether the binary is paid at expiration. Because let's say that at 1 p.m. today, that price is at 111.580. Would you make money or would you lose what you paid on entry? let's say it's 1 o'clock and this is the expired value. Would you lose or would you win? That's right, because it's not greater than, it's equal to. It always has to be greater than on the buy side, okay? So that 0 has to be at least 1. If it's 0, you lose. Does everybody understand that? And the same thing for the 111.62. Again, it would have to be greater than, so it needs to be 62.1. Same thing on the 111.54. It has to be 54 and at least have a 1 in that third decimal place. Does everybody understand that? Now, if we were short, okay, it could be equal to. So if you sold it, and that's, another term for selling is shorting the market. And if you sold, it can be equal to, okay? Only on the buy side does it have to be greater than, okay? But if you sold and it was 111.54, okay, that's not a problem. You would still receive the payout. I just do the last 3 numbers. Those are the numbers that make a difference to me. Because all of them are 111. It's 111, 111, 111. So what you're paying attention to in this case, Frank, is the last 3. And I mean, you could even get fancier depending on your level of experience, because let's say that, okay, we think it's going to be above all of these, but it's going to be below 111.66. Well, you could always come in and sell that one, okay? But if you do, realize that you're risking $81 to make $19, okay? But the probability is it will be under that 111.66 at the moment, okay? I mean, you can come up with all kinds of combinations. Do any of you trade regular options? Anybody in the room trade regular options, stock options? I think some of you do from the questions I'm seeing. Okay. Do you know how you can go long on a 7-day option and short on a monthly option? Okay. This is the same technique, but it's like on steroids. Is a good way to put it, okay? Because you can go on a daily and a weekly, or you could do a 2-hour and a daily combination. So, for example, I might think for the day it will be above this, but the 2-hour is going to pull back, okay? So you go short on a 2-hour, but, long on a daily, or vice versa. And where y'all can do it, on a monthly and a weekly, we're doing it on a daily and a weekly, or a 2-hour and a daily. The crude oil inventory report. It's a great opportunity to do that, because you could do a out of the money $25 on the daily, either long or short, and then you could go on the weekly and do another $25 one, and you have the potential to make money on both of them. But it's an every week trade that you have. Does that make sense to y'all? And ironically, I did not like options until I started trading binaries. And now it's just like, oh my gosh, there are so many opportunities here. Let me clear some of this off. on this one, this is the 15-minute chart. Oh, you're right. So on this one, this green bar tells me that this bar should go up. Because this is a reversal bar, and it's actually a substantial reversal bar. Do you see how it came down and made a low, and then they pushed it back up? Are you talking about this bar here, Giovanni? Okay, let me get the writing off my screen. Okay, this is bar 1, bar 2, bar 3. Which one are you talking about? So you're talking about this one here. This one said that the next bar would go down, okay? And it did actually, okay? So you had a bar that formed a high, okay? And then closed on the low. That predicted that this bar would go down, and it did, okay? And then they pushed it right back up. Does that make sense to you, Giovanni? It did what it was supposed to do, actually. And if you're thinking in terms of risk, now this is just in general because these premiums are always changing, okay? But if you were doing an out of the money, okay, at the close of this bar, you had this strike, right? Let's say that you were risking 40 bucks, okay? And this is a hypothetical because these premiums change all the time. And it goes down to 42, okay? You've made at least probably about 20 bucks, okay? And then you decide whether you want to get out of it or whether you want to stay in it. You know, I don't always stay in my binaries until expiration. I'm typically out because I do set profit targets. Does everybody understand that? You're saying you sell short when you see profit. If I'm comparing strikes and I see an opportunity to make a profit, I'll either sell short or I'll buy. And that's what you're looking at. Is there an opportunity here to make money? And if it is, then, you know, can you handle the risk is the next question. You know, I do not like the risk associated with in the monies. So generally, I don't trade them. Whereas I'm very comfortable with the risk on an out of the money. And that means as a trader, I'm not nervous over my potential loss on an out of the money trade. Okay. Whereas if I'm in the money, okay, and I'm risking, let's say $65, are you going to be second guessing your trade all the time? Are you going to be nervous and on the edge of your seat because you might lose that $65? And this is something that each individual trader has to actually, you know, decide for themselves. Nobody can tell you that. You have to decide that. I'm generally, I wouldn't say on the edge of my seat. Usually I might be watching a movie or something, or I'm writing an article or doing a presentation, but generally I'm at the computer and I'm monitoring it. And I do that because sometimes you'll find that it pops down and it would have given you a profit, but it didn't quite hit your profit target. Let's say I had my profit target at 85, okay, and it only got to 84, you know. Well, I would have probably caught that if I was sitting there watching it. Does that make sense to you, Frank? Yeah, typically my profit target is at 85. But let's say they hit 84 and they'll do it consecutively. I've seen it before. I'll just go ahead and exit. Sometimes they surprise me and they give me, you know, let's say my profit target's at 85 and within 10 minutes they hit 80, but it never goes higher than that 80 and I'm going to have to wait another hour for the $5. I'll just go ahead and exit. Because I'm weighing the time that I have to remain in that trade with the profit that I already have that I can lock in. And, you know, when you're a trader, you cannot go wrong by locking in profits. It's really that simple. Your job as a trader is to lock in profits. Okay, any other questions? Oh, thank you, Marvina. I appreciate that. Well, I hope everyone appreciated or actually learned something today. What do you notice that's going on now on this chart? I would be waiting personally if I was in this trade in my live account, which I'm not, because we're only learning today. I would be waiting on the next bar. This could make a pivot low and then bounce right back up. So that's what I would be watching for. But again, this is not a trade I normally take. Okay. Why do so many people lose money? That's really an opinion question, but most of the time, in my opinion, most traders lose money because they're jumping around trying everything under the sun instead of sticking to something. You know, and a lot of it is psychology. How many of you in the room love to lose money? Anybody in the room that loves to lose money? How do you feel when you lose money? You feel terrible, okay? We all want to win. That's in our nature. We want to win, and it's hard to take a loss and to take another one and to take another one. It's hard. It screws with your head, but you have to learn to work through that and say, look, you know, I know that losing is part of this business. How can I skew the odds in my favor? The answer for me personally was using risk to reward. Okay. It compensates for the losses. So I know, you know, more likely than not at the end of the month, if I do what my trading plan tells me to do, I will have made a profit. And I do the same thing over and over and over again. I don't change it. I don't like a lot of change anyway. I'm really not changing my trading plan. I might add, like I added the stochastics that I developed because I found a setup that I absolutely love. Okay. And I've added that one for a different trade setup, but basically I'm always entering at my ATR. That's it. The first thing that I recommend for new traders, Giovanni, is learn price. Okay. If you cannot learn the price bars, you're at a disadvantage. Okay. And second, learn trading psychology. Learn to write down everything that you're doing, do screen captures, explain to yourself, why did I take this trade? Was I stuck on stupid, or was there a reason for this trade? Okay. That's what you're looking at. ATR is average true range. It's something I built into my indicators. Okay, guys. I'm going to wrap it up for now. Thank you all for joining us. I really enjoyed the conversations we had today. I hope you learned something, and I'll be back next Wednesday. Okay?